And welcome back, listeners. Thank you for joining us for another episode of the Invisible Threat Podcast. And as is normal, I am joined here by co-authors and co-host of the Invisible Threat Podcast, Dr. Matt and Joanne Eby. They are both in remote locations in their new area, or renewed area, rather be, in Las Vegas. Matt, Joanne, how are you guys doing today?
Doing great out here in Las Vegas, where it's almost sunny every day. I think they get 300 days of sunshine every year in Las Vegas, and we really just enjoy our time out here. So thanks, Carter. Good seeing you again.
Yeah, absolutely. Joanne, you're actually off site. You're not at the home office, so to speak, but you back in the saddle again, right? In your retirement of not being retired.
Well, just doing a little bit of work, helping out where I can. I'm just passionate about the industry, so you know, keeping a little foot in the industry, feels good right now.
It's interesting before we kind of dive right into our latest episode. Joanne, when we first started doing this, Matt and I, it was sort of your idea for us to do this podcast. And I didn't realize, and maybe you didn't realize at the time, that we would be doing a lot of these shows together. But I am so grateful that we're able to get you on these shows, co-hosting a lot of them, and really extrapolating out all that amazing, not only passion for this industry, but the knowledge that you possess. So thank you so much.
You're welcome.
Well, again, listeners, thank you for joining us for another episode of the Invisible Threat Podcast. I want to mention again, as I did on the last podcast, make sure to connect with Dr. Matt and Joanne Eby on LinkedIn, because they are always giving tons of information on there, and we want to get their viewership and following up on LinkedIn as best we can. So, in our last episode, we talked about what Lindsay Day, great guest, again, thank you for the introduction to her, said during her interview, and we broke it down into 5 themes. I'd like to, with everybody's permission, dive in a little bit deeper into the conversation with Lindsay here for our listeners, and tap into your expertise in the fiduciary industry. This is for both of you and whoever wants to talk first, maybe. But everywhere you look, there's a discussion about risk and risk assessment. We have risk committees, internal audits, compliance reviews, regulatory examinations, governance reviews. And yet, we keep hearing about the same issues, the same themes, the same findings, the same concerns. So, I guess, Matt, I'll ask first, help me understand something. How can an industry continue to assess and monitor risk constantly and still keep repeating the same problems?
Well, Carter, that's a great question, and it's a question that we've continued to ask ourselves for years and years and years. If we continue to, try to improve things and change things around, how is it that we wind up coming up with the same issues and the same problems year after year after year? And I think it gets to the heart of something most fiduciaries have never stopped to ask. What if the issue isn't that risk assessments are failing, but what if they're simply doing exactly what they were designed to do in the first place?
That sounds like you're saying the problem isn't the risk assessment. It's what we're asking it to assess.
Exactly. It's what it's designed to do. And to understand that, I think we have to go all the way back to the original design of the risk assessment itself.
And Matt, as you know, most people don't realize this. Risk assessments were not designed for the fiduciary business when they were first created for bank regulated organizations. Instead, they emerged in the banking world because banking institutions were trying to understand what their exposure was, their credit exposure, market exposure, and capital exposure. And the original purpose of those risk assessments was visibility. And the purpose was discovery and identification of risks. The overarching purpose was to allow organizations to see the things that could hurt their institution before they actually became capital losses.
Interesting. So originally, they were just tools for seeing.
Exactly. They weren't inventories, they were not checklists, they were not giant spreadsheets. They were intended to help organizations identify uncertainty and challenge assumptions.
And over time, those risk frameworks evolved. Banks just got better at measuring their credit risk and market risk and capital risk. Then, after several years, operational risk came along. But operational risk was very different. Operational risk became a giant catch-all category, and basically everything that wasn't credit risk or market risk or capital risk ended up there, like technology risk, compliance risk, vendor management, business continuity, information security, legal risk, and reputation risk. Even many of those areas developed their own disciplines as they broke out away from operational risk itself. But then something very interesting happened.
Well, Matt, I'm on the edge of my seat and I can't wait. And hopefully our listeners are like, all right, what is it? What happened?
Well, like you said at the very beginning of this conversation, Carter, interesting to whom, right? And it was certainly interesting to me. I was in the risk world when this all first started, and this happened in the late 80s, early 90s. But as you could note from this, so we're talking about fiduciary risk. We're talking about fiduciaries in our podcast. Fiduciary risk was never really defined or included in any of these categories.
That's right, Matt. In this industry, we all use that term, fiduciary risk. Examiners use it, auditors use it, consultants use it, boards use it. But if you ask 10 people in the industry, 10 people to define fiduciary risk, you'll likely get 10 different answers or even some blank stares.
Well, I mean, that's actually true. You know, I've heard people describe fiduciary risk as compliance risk, right? I've heard others describe it as legal and regulatory risk. Others might even describe it as reputational risk. Others describe it as operational risk, almost like this catch-all you were talking about earlier, Matt. Maybe that's why it feels so elusive, right? We all talk about fiduciary risk, quote unquote, but nobody seems to agree on exactly what it is.
Exactly. And that raises a very uncomfortable question. If we don't have a common definition of fiduciary risk, how do we know we're seeing it? How do we know we're assessing the thing we think we're assessing?
All right. Okay. Well, so let me push on that comment a bit more. If risk assessments aren't seeing fiduciary risk, what exactly are they seeing then? Joanne, maybe you can help with this.
So, most are seeing controls that are related to operational risk. So, what you're seeing in those risk assessments are things like policies, procedures, exception processing, documentation, approval structures, escalation processes, governance frameworks.
Yeah, and obviously all of those things matter.
Absolutely, they do matter, and we're not criticizing them. All those things are important, but they're not the same thing as the exercise of fiduciary discretion. The most significant fiduciary activity that takes place in trust organizations.
And that's the key distinction. A risk assessment may tell you whether controls exist. It may tell you whether a process is being followed. It may tell you whether documentation is complete, but none of those things necessarily tell you whether fiduciary judgment is sound.
Well, in all of your years, I know this might be a big ask, but could you possibly give an example of that?
Not a big ask at all. I think it's totally appropriate. So let's just take a discretionary distribution request, fairly common. Lindsay talked about this in her description in her interview. The trust officer follows the policy when they get the request to do a discretionary. They review the document and sees that, yes, we can do this distribution according to the provisions of the trust. And then that trust officer judges at that point that we should not do this. They document the file, they obtain committee review, and they deny the request. They complete every required step. The controls worked, the process worked, the documentation worked, but was the judgment sound? That's where fiduciary risk actually lives. And that's exactly where the traditional risk assessment stops seeing. This is the essence of fiduciary risk. And that's a completely different question.
Or maybe we can take into consideration a beneficiary interpretation. Two beneficiaries present similar requests. One beneficiary out of their trust receives approval. The other beneficiary does not. The files are likely perfectly documented. The committee involved will have followed every procedure, but the real fiduciary work was not the paperwork, not the committee process. The real fiduciary work was the interpretation of the individual or the committee making the decision. And that's the essence of fiduciary risk. As far as I'm aware, there is no risk monitoring that includes this fiduciary risk exposure in its current assessment.
So those are both very, very interesting examples that we could drill down to, I'm sure, at another time. But so the most important fiduciary risk may be the one that never appears on the risk assessment at all. Is this to quote our podcast, an invisible risk?
That's another great question, Carter. There's no way for the current risk assessment tool to incorporate this. The risk assessment was not designed for fiduciary risk.
So, okay, I want to go back to our amazing guest that we had, Lindsay Day. This reminds me of our conversation that we had with her. One of the 5 themes she talked about was the difference between a competent fiduciary and an exceptional fiduciary. And at the time when she was saying it, I was thinking, man, it feels like those lines could get blurred pretty easy in competent, exceptional. So, Joanne, do you want to talk a little bit about that?
And as Lindsay mentioned, it's like a competent fiduciary. I've never come across any trust officer who wasn't absolutely competent, even new ones. The frameworks in place in organizations really kind of, at least give them a good framework to be a competent fiduciary. It gives them an understanding of the rules, the document, the procedures in the organization, the standards that they have in place. The exceptional fiduciary understands the person sitting across the table, the context of the discretionary request, the ambiguity involved maybe in the trust document, the tension, the things that are not immediately visible, the things that are hard to quantify. Both the competent fiduciary and the exceptional fiduciary are likely to be acting as trust officers in the same institution at the same time, with different account books, of course, and they're both doing their level best to make sound fiduciary judgments. Yet it's possible that the outcomes can come across with similar situations in different ways.
And here's the question I would ask every listener: show me where that gap appears on a traditional risk assessment used in a trust organization. Show me where we assess the quality of fiduciary judgment. Show me where we assess the interpretation. Show me where we assess how discretion is actually being exercised. Most organizations will struggle to answer those questions.
Yeah, so maybe the issue isn't that risk assessments stopped working.
Exactly right. I think they became very good at seeing exactly what they were designed to see.
And the question is whether fiduciary risk was ever located in those risk assessments in the first place.
And that's the question. Because if fiduciary risk primarily resides in judgment and risk assessments primarily evaluate controls, then in the fiduciary world, we may be measuring everything except the thing that matters most.
Well, I'm just going to say this. That's a pretty uncomfortable conclusion.
It should be, because it suggests that we in the industry may not have a fiduciary risk problem. It may be that we have a fiduciary risk definition problem. And until we define it properly, until we define fiduciary risk accurately, fiduciary risk will remain difficult to see, not because it's hidden, but because our risk assessment instruments were never designed to see it in the first place.
For decades in the trust industry, we've assumed that fiduciary risk could be managed using those same risk assessment frameworks that were developed for things like credit risk, market risk, and operational risk. And maybe to a certain extent, that's true. But ask, maybe fiduciary risk itself is fundamentally different.
Maybe fiduciary risk doesn't begin with a failed control. Maybe it doesn't begin with a failed policy. Maybe it doesn't begin with a failed procedure. Maybe it begins much earlier, in a conversation, in an interpretation, in a moment when discretion is being exercised, in a judgment call. But if that's true, then the most important risk in the fiduciary business may be forming long before any traditional risk assessment can see it.
And I just have to say that raises the question we're going to tackle next time, right? If fiduciary risk doesn't primarily originate in controls, if it doesn't primarily originate in policies or procedures, then where does it originate? And more importantly, can we identify those places before the risk materializes?
Because if we can, we may finally have a way to see fiduciary risk while it is still forming. Not after the damage may occur, not after the examination, not after the committee decision, but while fiduciary judgment is still being formed.
Yeah, well, here's the thing. Next time on the invisible threat, we are absolutely going to get deep into this. Here's what I say over and over again. Most organizations move past these moments. We don't. Matt, Joanne, as is always, thank you so much for trying to help identify these things, trying to make the invisible visible, right? It's so critically important. And Joanne, seriously, it's so amazing to be able to have you impart your wisdom on our audience. So, as is normal, I really do appreciate it. I know I tell you that all the time, but it's such an honor for me to be able to sit here and help to um, elicit these questions and get this engagement going between the two of you. So thank you guys both for being available to do this.
You're welcome.
Listeners, listen up. Make sure to like, share, and subscribe. Make sure to connect on LinkedIn to be able to get more of this type of stuff out there. Wherever you get your podcast, Apple, Spotify, whatever the case may be. So for my esteemed co-host, Dr. Matt Eby, and his wonderful co-author of the Invisible Threat podcast, or Invisible Threat book, Joanne Eby, I'm Carter Wilcoxson, CEO and founder of Epic Services Company, thanking you for joining us for another episode, and we will see you next time on the Invisible Threat podcast. Thank you, everybody.
Thanks, everybody. Bye.